Welcome to Charged Alpha, where we decode earnings prints one rail at a time. Today, we're cracking open Norfolk Southern's first quarter of 2026, and the print tells two very different stories.
Earnings per share came in at $2.43, missing the $2.49 consensus by 2.4%. Revenue squeaked past at just under $3 billion. The real story, though, is in the operating ratio.
That operating ratio jumped back to 70.7% after dipping to 64.5% in the second quarter of 2025. It's the number that defines this turnaround, and right now it's flashing yellow.
Yet the stock sits at $319, near a 52-week high of $323. The market is pricing in faith. The question we're asking today is whether that faith is earned.
I'm Hudson Thomas, your story guide through the numbers, and beside me, as always, is the analyst who actually reads the footnotes.
I'm Lana Chen. Let's get into it.
Norfolk Southern is one of the great American freight railroads, headquartered in Atlanta, Georgia, and trading on the New York Stock Exchange under the ticker NSC. The company traces its modern form to a 1980 merger of two storied lines.
Today, Norfolk Southern operates roughly 19,300 route miles across 22 eastern states and the District of Columbia, employing around 19,600 people. Market cap sits at $71.77 billion on the 225 million shares outstanding.
Think of the network like the eastern half of America's circulatory system for goods. Coal, chemicals, autos, intermodal containers. If it moves heavy and far, there's a decent chance it rides a Norfolk Southern flat car.
The revenue mix breaks into three buckets. Merchandise is the largest at 51.8%, intermodal contributes 29.6%, and coal still generates 18.6% of the top line.
That coal slice is shrinking structurally, but it's also high-margin tonnage that keeps the operating ratio honest. Losing it isn't free. It has to be replaced by intermodal and merchandise growth.
The moat here is geography. You cannot build a parallel 19,300-mile rail network in 2026. The land, the rights of way, the federal approvals, it's an irreplaceable franchise asset.
Why does this episode matter now? Because the stock has nearly doubled from its 2024 lows, and the bull thesis hangs entirely on whether precision scheduled railroading actually delivers a mid-60s operating ratio.
Revenue grew just 0.2% year over year on a trailing basis. So this is not a top-line story. It's a margin story, an efficiency story, and a credibility story.
Activists pushed Norfolk Southern hard in 2024 after the East Palestine derailment and a period of operational drift. The board responded with leadership change and a renewed focus on cost discipline.
Return on equity sits at 18.5%, gross margin at 51.1%, and net margin at 21.9%. These are healthy industrial profitability metrics. The debate is whether they can expand from here.
Speaking of leadership, let's talk about the man holding the throttle. Mark R. George took the CEO chair in September of 2024, stepping in after Alan Shaw resigned under that activist pressure.
George is a finance-first operator. He joined Norfolk Southern in 2019 as Executive Vice President and Chief Financial Officer, arriving from senior roles at Otis Elevator, United Technologies, and Praxair before that.
That CFO pedigree matters. The activist case demanded cost discipline, and George knows how to read a cost stack. He's now executing the precision scheduled railroading playbook that the board promised investors.
His stated target is an operating ratio in the mid-60s. The second quarter of 2025 hit 64.5%, which proved it's achievable. The challenge is making it durable across seasonal swings.
Analysts I've read describe George as competent but still on probation. The first quarter of 2026, print at 70.7%, gave skeptics a reason to question whether last summer's number was structural or seasonal.
His equity package is tied to operating ratio performance below 65%, which means his personal incentives sit exactly where shareholder incentives sit. That's the kind of alignment activists like to see.
All right, let's open the financial hood. Where do you want to start? Valuation or income?
Let's start with valuation. Norfolk Southern trades at a price-to-earnings ratio of 26.9, an enterprise value to EBITDA multiple of 13.75, a price to sales of 5.89 and a price to book of 4.54.
That price to earnings above 26 feels rich for a railroad whose top line grew 0.2%. Investors are clearly paying for the operating ratio improvement, not for the current run rate.
On growth and income, trailing 12-month revenue is $12.185 billion, and trailing earnings per share is $11.87. Trailing net income lands at $2.671 billion.
The full-year picture in fiscal 2025 showed earnings per share of $12.75, up from $11.60 in 2024. Analysts expect 2026 to come in slightly lower at $12.50 before re-accelerating.
The forward curve is more interesting. Consensus puts fiscal 2027 earnings per share at $13.37 and fiscal 2028 at $14.70. That's roughly a 17% two-year acceleration baked into the multiple.
On margins, gross margin is 51.1%, the operating margin around 32.4%, and net margin 21.9%. These are strong, but the historical trend tells the real story.
Fiscal 2022 saw a 37.8% operating margin. That's the peak the Bulls want to revisit. It collapsed to 29.8% in 2023, then recovered to 35.2% in 2024, before settling at 32.9% in 2025.
So the question becomes, can George push margins back toward that 2022 high watermark? Every 100 basis points of operating ratio improvement is real money on this revenue base.
Cash flow is solid but tightening. Operating cash flow ran $3.755 billion on a trailing basis. Capital expenditure was $2.01 billion, leaving free cash flow of $1.754 billion.
Quarterly free cash flow tells a more cautious tale. The first quarter of 2026 generated $344 million in free cash flow, down sharply from $720 million in the third quarter of 2025.
That's a real watch item. The dividend yields 1.69%, paying $5.40 annually, with a 45.4% payout ratio and 20 consecutive years of payment.
20 years of dividends is a meaningful capital return signal. But buyback acceleration is what bulls really want, and that depends on free cash flow holding up.
Now the balance sheet. Total debt sits at $17.1 billion against $1.34 billion in cash, putting net debt at $15.76 billion. Total equity is $15.8 billion. Total assets, $45.1 billion.
The leverage ratio is what jumps out, net debt to EBITDA at 2.66 times. That's manageable for a regulated railroad, but it's not exactly room to run.
Interest expense ran $788 million on a trailing basis. That's a real fixed cost that constrains how aggressive Norfolk Southern can be on buybacks until leverage works lower.
So putting it together, what's your read?
Overall, Norfolk Southern's financial health is solid. Profitability and cash generation are healthy, but flat revenue and 2.66 times leverage limit flexibility until the operating ratio compresses durably.
All right, let's see what Wall Street thinks of all this. Walk us through the consensus view.
15 analysts cover Norfolk Southern, 6 rate it buy, 9 rate it hold, and 0 rate it sell. The consensus label is hold with a mean price target of $3 to $41.
With shares at $319.58, that $341 target implies roughly 6.7% upside. That's a tepid implied return for a stock that's already had a huge run.
The bull camp is led by Barclays at $375 and Wells Fargo at $370, both overweight. B of A Securities is at $358, UBS at $352, and TD Cowen at $45, all buy ratings.
Bernstein sits at $340 with an outperform. Then we drop into the cautious tier. JP Morgan neutral at $325, Citigroup neutral at $318, RBC sector perform at $310, and Deutsche Bank hold at $300.
The spread from Deutsche at $300 to Barclays at $375 is $75 wide. That tells you the street genuinely disagrees about whether this turnaround is real or already priced in.
On the last earnings print, the first quarter of 2026 missed earnings per share by 2.4% at $2.43 versus $2.49 consensus. Revenue beat by 0.1% at $2.998 billion.
Compare that to the prior 3 quarters, all beats. The fourth quarter of 2025 crushed by 16% at $3.22 versus $2.76. The first quarter of 2026 broke that streak.
When a momentum stock breaks an earnings beat streak right at all-time highs, that's when the cautious analysts start sharpening their pencils. Watch for downgrades if operating ratio doesn't snap back.
Bottom line on the Street View, consensus is patient but not enthusiastic. The risk-reward at 319 with a 341 target is balanced rather than compelling.
Let me make the bull case. First, the precision scheduled railroading playbook is genuinely working. The second quarter of 2025 operating ratio of 64.5% proved the mid-60s target is reachable, not aspirational.
That's a fair starting point.
Second, the moat is irreplaceable. 19,300 miles of Eastern rail across 22 states cannot be duplicated, and that means pricing power compounds over decades, not quarters. Third, leadership alignment is real. Mark George's equity vests against an operating ratio below 65%. So when shareholders win on that metric, he wins, and when they don't, he doesn't. Fourth, capital return is set to accelerate. With trailing free cash flow at $1.754 billion and a 45% payout ratio, buyback capacity grows meaningfully once leverage drifts below 2.5 times. And fifth, East Palestine remediation costs are rolling off. That headline risk overhang has been a multi-year drag on sentiment, and the financial cleanup is well past peak.
My turn. First, the operating ratio regression is the entire bear case in one number. The first quarter of 2026 came in at 70.7% versus 64.5% in the second quarter of 2025. Second, revenue growth is essentially zero. Trailing top line grew 0.2% year over year, which means every dollar of margin gain has to come from cost cuts, not volume leverage. Third, valuation is unforgiving. A price to earnings of 26.9 and price to sales of 5.89 leaves no margin for error if the operating ratio doesn't compress as promised. Fourth, coal is structurally declining. That's 18.6% of revenue facing secular pressure from utility conversion, and intermodal growth has to fully offset just to hold the top line flat. And fifth, the balance sheet is constrained. Net debt to EBITDA at 2.66 times and $788 million in annual interest expense limits. How fast capital return can accelerate?
Two coherent cases, neither making a recommendation, just laying out where the debate actually sits.
Let's see how Norfolk Southern stacks against peers. The eastern competitor is CSX at a 5.2 price to sales with 2.1% revenue growth.
Western rival Union Pacific trades at 5.7 times sales with 1.8% growth. Canadian National Railway sits at 4.8 times with 3.5% growth, and Canadian Pacific at 5.5 times with 4.2% growth.
Norfolk Southern stands out at 5.89 times sales with just 0.2% revenue growth. That makes it the most expensive rail on price to sales while showing the slowest top-line expansion.
That's the valuation tension in one line. Investors are paying a premium multiple for the slowest growing peer because they're underwriting a margin story, not a revenue story.
The Canadian rails, Canadian National and Canadian Pacific, are the growth standouts here, both above 3.5% revenue expansion. They benefit from cross-border trade flows that Norfolk Southern doesn't fully capture.
CSX is the cleanest comp because both serve the eastern United States. The fact that CSX grows 10 times faster on a third less valuation premium is something the bears keep circling.
Relative positioning is clear. Norfolk Southern is priced as the turnaround call in the rail group, not the growth call or the value call. That's a specific bet on margin execution.
On to options activity. The put-call ratio sits at 1.0, meaning equal volume in puts and calls, a textbook neutral reading with no directional pressure.
Implied volatility runs at 26%, which sits in roughly the middle of the historical range for industrial large caps. Options aren't pricing a major surprise in either direction.
Open interest is spread without any standout cluster on a specific strike. There's no big institutional bet visible in the chain right now.
Standard caveat: options data is a snapshot of expectations on the recording date and reverses quickly when sentiment shifts, particularly through earnings windows.
Translation: the options market is saying it doesn't know which way the operating ratio debate resolves, and it isn't paying up for either side.
On insider activity, specific transaction counts are unavailable for this window. What we do know is that CEO Mark George holds performance equity tied to operating ratio targets below 65%.
That's the alignment story I keep coming back to. His personal compensation is locked to the same metric the activist investors demanded: direct shareholder alignment, in writing.
It's not a buy or sell signal, but it's a structural reason to believe leadership will pursue the operating ratio target with conviction rather than hedge against it.
On risks, the headline issue is operating ratio regression. The first quarter of 2026 at 70.7% versus the fourth quarter of 2025 at 68.5% reignites the seasonal versus structural debate.
Second, East Palestine long-tail liability remains an unknowable. The financial reserves are set, but litigation timelines and regulatory aftermath can still produce surprises through the rest of the decade.
Third, coal is in secular decline. That's roughly 19% of revenue facing structural pressure from coal to gas utility conversion across the eastern grid.
Fourth, the balance sheet sits at 2.66 times net debt to EBITDA, which constrains capital return until earnings grow into the leverage. The next forward catalyst is the second quarter of 2026 print on August 4th.
Consensus for that print is $3.17 in earnings per share on $3.184 billion in revenue. Operating ratio commentary will matter as much as the headline numbers.
So summing up the bottom line, Norfolk Southern is a credible turnaround in motion, with a CEO whose incentives align with the metric that matters, but valuation already prices in success.
The first quarter of 2026 print at a 70.7% operating ratio reset the bar. The next two quarters need to walk that number back toward the mid-60s, or the multiple gets harder to defend.
The single most important metric to watch is the quarterly operating ratio trajectory. Below 67% on a sustained basis validates the turnaround. The second quarter of 2025 at 64.5 set the benchmark.
That metric is the report card, the thesis, and the share price catalyst rolled into one number reported every 90 days.
Everything else, revenue, free cash flow, capital return, flows from whether that number compresses durably or oscillates with the seasons.
We'll close with a line that captures exactly where this company sits today. From Charged Alpha, the operating ratio is Norfolk Southern's report card, and right now it's showing B- work when the market needs A- proof. That's the whole episode in one sentence: a real turnaround, a real CEO, and a stock priced for an A. The next quarter answers the question. Thanks for spending earnings day with us. If this helped sharpen your view on Norfolk Southern, follow Charged Alpha and share the show with someone who reads the operating ratio before the headline. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.